Hey everyone, it is Ian, and today we have another trade idea that we're going to be discussing. This is going to be an earnings trade idea on Charter Communications. They report their earnings results on Friday, October 28th, before market open. But before we get into the details on this trade idea, we're going to be breaking down something in this particular video that is going to go over the difference between iron condors and straddles and what the pros and the cons are between the two, when we should put, whichever one on and what situations call for each. All right, so today let's first break down the trade idea, and then this will provide a concept, hopefully for some of our newer traders, on when to place an iron condor on an earns trade and when it might be best to do a straddle. At the end of the day, it's going to come down to your own risk tolerance, your own level of confidence for each given trade. That is the component where this becomes up to you. But we're going to be covering all the risk measures and everything in between. So without further ado, let's break down Charter. Ticker symbol CHTR. Now, if we go on the volatility or on the earnings tab, sorry, I was looking at some stuff there as well. If we go into the earnings insights tab, what we can see is that of all the names that report on Friday before market open, Charter is the most overpriced in terms of implied move versus average move. This doesn't mean that it's overpriced. It just means that the market is expecting a move from Charter that is, 100, basically 44% higher than what it usually is. Yeah, we can see this here. We have an implied earnings move of 6.63%, an average move of 4.6%. We can see the straddle performance is great. This has returned 112%, almost 113% if you've been short this thing during its recent earnings cycles, like the past 20 quarters or so. And we have a maxed realized move during these quarters of 14.19%. This came on January 31st of 2019. So, with that being said, and breaking down all the logistics here further, right? We can come down here and we can see that the implied earnings move has actually gone up in the past couple of weeks. This could be due to a lot of the volatility that we've seen in earnings. Think of names such as Microsoft and Google, for example, reporting their earnings and both having extremely volatile days, or Meta Platforms, which is down, I believe, 15% after hours. So this kind of makes sense, right? And what we also like to see is this back test here showing that this is typically a really big winner. Some small losers, actually. So this is typically inverted. Usually what you have with earnings is you have a bunch of, small winners and then one big loser. This case, we actually have really, really big wins here, really small losses, and then just one blowout loss. So we're going to be discussing all of this into further detail in a second, but I do want to make note of this max realized move. Okay, I want everyone to note this, especially the newer traders, because this is actually going to come into play on Condors versus Straddles. So now if we go to the relative value tab and we just run the IV30 versus the subsequent realized or the non-event implied volatility for the next 30 days, we can see again that this is right around the range of expensiveness, right? This is pretty much average, so to speak, and we kind of like that. You kind of want to see, volatility as a whole on these given names, especially for earnings, to be within the same mark as where it usually is at, right? Especially on trades that like this, which we know historically are profitable to be short on. So how do we go about structuring this thing? Well, I've kind of already broken this down, right? We've said that it looks expensive. It looks expensive because overall we can see that it's profitable to be short on. We have an implied move well above the average move. We have an implied move well above the average implied move. This seems like a pretty profitable trade. It seems, pretty clear cut, right? We can kind of also stem a point of why we've seen this rise in implied volatility. Could be some bigger names having extremely volatile earnings events. So now we have to go about structuring the trade. Okay. So there's really two ways you can do it for now. And these two ways are pretty simple. First, we're going to break down the straddle. Okay, so the straddle is number one, you're going to get the most bang for your buck on the straddle. Right? We can see that this is trading currently for a credit of $24. $23.95 to be precise, versus the Iron Condor, which is only trading for a credit of $17.52, right? So you're getting more bang for your buck. If you're extremely confident in this trade and you think that this is going to pancake, right, and it's not going to move a lot, you're in the market to make somewhere around, over $1,000 per bet, if that is the case. Now, your break evens here on the straddle are pretty much going to be, very close to the implied move. It basically is the implied move given the short amount of days left, right? So when you put this trade on, let's say if someone did put this trade on tomorrow, so October 27th, right, before the close, and they put this trade on before the close, and then they take it off in the open, it's basically like it has 1 day to move. It's basically almost all earnings volatility is associated with this thing. Now, I want you to remember these break-even points here. These are the same break-even points for when I'm about to put on the Iron Condor. Do you see the difference here? Do you see the difference? 321, right? 321. Well, that's the break-even for the straddle. But why is the break-even on the Condor, why is it here at 327, not 321? Well, guys, this is some of the edge that you're giving with an Iron Condor. A straddle is going to reflect your view. If, say, your short earnings volatility, the view that is going to most significantly reflect that view is going to be a short straddle. Always. It will always be a short straddle. So, with that being said, Iron Condors are another way that you can express the view, but with, you're basically not putting as many chips on the table, so to speak, right? Let's go back here to this straddle. This is the second major difference between the two. Straddle, you have infinite risk. Infinite risk to the upside and the downside, right? Because we're not hedging. We're not buying any options here. We sell this straddle on the earnings event. We're at the mercy of whatever happens. It's not like we can buy options after hours, right? Now with the Condor, we do. We do buy options. We buy the 320 put. We buy the 370 call. Our losses are capped at $748 each way. And we could still make, depending on if you actually held this all the way to expiration, basically almost more than 2-to-1 risk reward. But we're giving up a little bit of edge because the most we can make is only around, this credit of $17.52. The most we can make here is almost $24. So to summarize, Iron Condors are a safer way of placing trades. There's capped risk, as in there is a set amount of money that you can lose, right? And further, straddles have there is no cap risk. It's uncapped. You can lose technically infinitely amount, an infinite, an infinite amount of money on straddles, right? However, your exposure to the event is going to be more. Now, which one, and this is probably the big question people are asking, but which one do you do then? Which one do I place then? Well, remember this number that I mentioned back here? Oh, sorry, guys. Oh, God, I clicked the wrong thing. Sorry. That's math homework. So, well, remember this number I mentioned? Right here, the max absolute realized move. Well, let's say you're a trader, and let's say your risk tolerance level is a little bit lower, maybe you have a smaller account, whatever the case may be. And you see this and you go, well, I think that with, market volatility and the earnings volatility that we've seen on Google and Microsoft, etc., and Meta platforms, there's a chance that maybe we see something like this, a more increased chance of seeing something like this, right? So if that's the case, well, then what you want to do, maybe, is maybe you say, okay, I do think this might be expensive, but I'm not fully convicted. So I'm going to sell a Condor. Now, personally, depending on the size of your account, if you have a bigger account, more times than not, the better trade is probably just going to be to tone down the size on the straddles. And the reason that is because if we go here and take a look at these options on Charter, what you're going to notice, for example, on like that 320 put I mentioned, this spread is pretty wide. It's a $50 wide spread here, right? On the 370 calls, we can see that we have a $60 wide spread here. So the spreads are wide, right? There's less liquidity usually out in these areas, right? You can see that there's a lot more liquidity here. We have volume of, in the 80s, open interest in the 100s. We go out here to these, the 320 range, we have volume of 1. So less liquidity, it can be harder to get in and out of these positions, right? So that's another thing that you should probably be factoring in. Now, for people that have accounts where, if you put on just one straddle and this moved 2 standard deviations, right? So it moved something like this, it moved, like around to here. And this was like a almost $3,000 loss, and this could bankrupt you. Then the trade might be to put on a Condor. In the long run, though, straddles typically are the more profitable trade because think about it, right? From the law of large numbers perspective, if you are taking a trade and the trade overall is positive in the long run, you want to get that exposure to that positive, that edge, right? You want to maximize it. You don't want to limit it because when you're wrong, with the straddles, yes, you're going to lose a lot of money, but you're also going to make more money in a profitable manner. In the long run, typically speaking, this is more profitable. Also, lastly, the event. Remember how I said the straddle is literally how the implied move is essentially derived. I mean, it's derived through implied volatility, but your break even on the straddle is going to be the implied move, right? That's not technically the case with iron condors. Remember I said you're giving some of that edge back? Your break evens are shorter. You don't have as wide of break evens as on the straddle. So you have to factor that into your analysis. If you expect that this is only going to move by, let's say, 3% instead of 4-5%, right? Or in the direct case for Charter, this is only going to move 4% instead of, the break even of being 6%. That has to be factored into your analysis, right? If you're placing the trade, right, and you're betting that it's going to be its average move, but the average move is right around, the break even of the Condor, the better bet is probably to take the trade on the straddle. So these are all types of things that we look at when placing, options trades. Like I said, guys, to summarize, typically more times than not, the better thing to do is just tone down your size on the straddle instead of taking the iron condor due to the liquidity risks on the wings. Then there's things like skew as well, which we're going to be covering in later videos, and because you're giving back some edge to the market. It's just always important to remember your risks and remember your confidence levels as well. So with that, guys, I hope that you really enjoyed this video. If you guys have any questions on this, feel free to message me. And with that, I hope you guys have a great evening. Take care.